gentlemen, Assalamu alaikum. I welcome you back after, hope you had a good lunch, and we apologize for the slight inconvenience for the delay in opening of the restaurant. So we apologize for that slight glitch. After lunch, of course, it's quite a difficult task to keep the audience alive, especially after this heavy lunch, but inshallah we have planned this session in a way that definitely our presenters, two presenters, will keep you awake till the end. After the lunch, we had planned this post-lunch workshop on VAT, basically, and in the panel session which we had just before the lunch, we noticed that many participants were eager to ask questions, or some of the points might have remained unanswered. So taking this opportunity, the presenters and the audience will have ample time during this session to ask questions from the presenters. So without further ado, I'd like to invite our first presenter, Mr. Adnan Mufti, who you had the chance to hear, to see during the panel session, who moderated the first session, and he will give a presentation on indirect taxes in the kingdom, implications of VAT and impact on businesses. Adnan Mufti is a partner of Sheikha and Mufti Moore Stephens in Pakistan office. So I'll request Adnan to straight away come and start his presentation. And the second presentation will be given by our second presenter, who has specially flew from Dubai, Sayyid Asif Zaman. He is the president of ICAP UAE chapter, and he will also touch upon the practical issues of, especially on the treaties between the governments. So he will touch upon those issues in the second presentation. So a big round of applause for Adnan Mufti.
Bismillahirrahmanirrahim. Assalamu alaikum. I'm sure it is going to be a challenging session for you and for me too, because after the lunch, it's always difficult to digest theory. But I'll try to do justice as much as I can. The session is basically divided into two parts. One is the theoretical aspect and the other is the practical aspect. So basically, what I've been able to gather since morning, there is a tremendous interest as well as tremendous confusion among the participants and the public at large as to what will be VAT, how will VAT affect their businesses, what are the key principles, what is the framework, although the law is yet to come, but at least we know for a fact how it's going to work and how it's going to apply your own entity. So basically, value-added tax, as you all know, is a multi-stage levy charged at every stage of the supply chain. It is collected on the imports and the supply of goods or rendering of services. At the time of import, the importer is responsible for payment of VAT, whereas on the service side, the supplier, the service provider is liable to pay tax, and VAT also carries an interesting element of reverse charge. We'll discuss it later on. Basically, the adoption, as we discussed in the panel discussion this morning as well, the adoption of VAT is basically aimed to improve neutrality among countries, which like in the EU. Of course, it is, for example, in Pakistan, it is the largest source of revenue for the government. So it basically yields a lot of revenue for the government and, of course, improve competitiveness. Now, there is a unified agreement for VAT across GCC that has been published. And according to that directive, I would say, GCC countries expected to introduce VAT from 1st January. Then each member country will transpose its own provision according to they will basically be entitled to bring up their own VAT law. So in a way, what we did not foresee in the beginning, there could be deviations, there could be planning areas as well, because a particular product may not be taxable here and may be taxable in Oman, for example, in Bahrain, and vice versa. There could be a reduced rate here and there could be a full rate there. There could be a zero ratings on a particular good or service, whereas in the other member state there could be a full charge. So there you may see differentiation, and that particular area will devise its own mechanics for tax planning or tax modeling, as I would say. Then it will be an EU type model which will bring all the GCC countries into a common economic zone. Then a single rate of 5% has been prescribed. There will be zero ratings, there will be exemptions. For example, an interesting thing that has emerged in this particular unified agreement that has been made public recently, it says that health, education, real estate, local transport can be taxed, can be made exempt, and can be taxed at a zero rate. This particular aspect has been left to the member states. So there again, as I just mentioned, we can see deviations. Then again, financial services is a very interesting situation that is emerging at the moment. Financial services may be exempt. Largely, I tell you, financial interest income, or we would say profit or markup or whatever we may call it, it is largely exempt from VAT. It is only the other income, it is only the documentation charges or the other stream of revenues that the bank or financial sector accrues. Basically, that is always VATable. But here, what has been explained to us, it may be exempt, but it may be treated in a very unique way, whereby all the VAT's input may be claimable. We'll discuss this later on. Then, of course, imports will be taxable. There will be export zero rated. Intra-GCC goods and services, there will be reverse charge principle. We'll discuss later on. There will be a mandatory VAT thresholds of 375,000 riyals. We'll discuss later on. Then there will be, of course, in all VAT jurisdictions, there is a proportionate VAT claimability. So that will apply evenly in your part of the world. Then again, basic food, bread, milk, they will be zero rated, but it is likely that all other goods except this basic, what is in front of you, will be taxed. Medical equipment, medicines may be zero rated, and there will be specific rules for place of business or intra-GCC transactions. We'll discuss later on. Again, as far as the group taxation is concerned, grouping is concerned, it is again up to the discretion of the member states whether they apply it, whether they incorporate these provisions, whereby payment situation, a cash negative position may be offset against a cash positive position of your associated company, meaning thereby if one entity, if the group taxation is in place, a particular entity's liability may be offset against the other's refund. So basically, this is again up to the member states whether they want to go ahead with that or not. Now in front of you is basically IMF report that was published way back in 2015. You can see it is divided into three parts. The first one is the oil producing countries. The other one is other Middle Eastern countries. And the third one is other comparative countries. You can see in previously, and basically this is the reason, one of the reasons primarily why VAT is going to be introduced in this part of the world, that if you see the VAT revenue as percentage of the GDP in oil producing countries, it was as low as 0.1%, whereas in case of New Zealand you can see it was 9.7%, or in case of Jordan, it was 10.4%. So basically, what I just wanted to share with you is the amount of revenue that it basically gives to the government and the state for its own revenue, infrastructural investments or other side of types of social expenditures that the state wants to carry out for its citizens. Now, this is basically VAT has been in existence for over 50 years and has been implemented in 150 countries. France was the first one to introduce VAT in year 1954, and the latest adoption was Malaysia in 2015. This is basically a glance of the overall rates starting from Australia. Again, I would, in Pakistan, for example, it is 17%, but having said that, I would say that 17% is standard rate. In some area, in some cases, it basically is increased to over 27 or 28%. So you are fortunate enough that it's going to be one of the lowest rates that you can have in a VAT law. Now, these are the basic advantages and disadvantages. You see, if you can see, a VAT may eliminate the complex income tax system because it will create a lot of revenue for the government, but again, it can be regressive. Of course, VAT can also be imposed on online transactions, e-commerce, but on the negative side, it can lead to excessive spendings. It is again based on consumption, has the potential, we just discussed this, it is neutral because it applies to all businesses, but again, it will be very harmful for someone who is not prepared for it or some new entrant in the business. There is a concept of self-assessment in VAT all across the world. However, for example, in UK law, in our local law, there is a concept of joint liability whereby the buyer can also be held responsible for the non-payment of VAT that had to be paid by the supplier himself. Then, of course, there is an incentive for exporters. All the taxes that they pay, they get a refund for it. But if they are not honored, then that create a difficult situation for as far as liquidity is concerned. Now, how VAT works? These are the key features. It is a transaction-based tax. It is on consumption. VAT that you charge is your output tax. What you suffer in your purchases is your input VAT. It is simple, but can be made complex. It works on accruals. You have to pay on your sales whether or not you have recovered the money or the tax from your buyer, and vice versa. You can claim also the VAT that you suffered on your purchases on accrual basis. Self-assessment, again, collected by businesses on behalf of tax administration. Then banks, again, businesses, of course, since it works on a self-assessment basis, you determine your own liability and you pay tax. And of course, there are penalties attached to it for non-compliances. These are primarily these are the areas which are essential in a VAT system, and we'll discuss this later on. But the paramount important area is the supply concept. The scope revolves around supply, but supply is further divided into the place of supply, the time of supply, the value, etc., etc. So, coming to the scope, VAT is charged on taxable goods if you supply them. Then VAT is charged on services rendered by a registered person, or you can say a taxable person who is taxable, who is called a registered or taxable person, in the course of a taxable activity. That's very important. So we'll discuss this later on. On import of taxable goods, we just discussed this, and the reverse charge concept says that when you are receiving services, then you need to pay VAT as a recipient, just like you pay tax on the import of goods. Now, having said that, this is something very interesting. people generally believe, they feel that VAT is payable on sale of goods. It is not. Sale is only a component. It is basically a VAT. VAT is basically on supply. And supply has a very wider connotation. What is supply? Supply is sale, number one. Then if you transfer the rights for disposition of goods as owner, the other party, you transfer your rights of goods, someone else is entitled to sell these goods as owner of the goods, then this transfer of right will also be equated as supply. Then if you sale or transfer under hire purchase agreement, this is also supply. Then if you consume goods, you manufacture a particular goods and then you consume it yourself. You distribute it among your employees. You distribute among your customers. This is also a supply and liable to VAT. Then of course, auction or disposal of goods to satisfy a debt. This will also be a VATable transaction. Rendering of taxable services, and of course the reverse charge that we just talked about. We'll have separate discussion in the later part of this presentation. This is basically supply. A car is sold, you sell your car, you receive cash. You obtain legal services, this is supply. Then, of course, there is insurance policy against insurance premium. This is a supply. And interesting situation is that there is a concept of deemed supply. That if your product gets lost or burned or by way of theft, you are not able to basically sell them, and you recover the insurance proceeds. That is this is deemed to be a taxable supply, duly VATable from the insurance company. But in many jurisdictions, this is called, for example, in the EU, it is deemed to be a taxable supply. In Pakistan, for example, it is outside the ambit. This is not, no VAT is payable on these transactions. Now, there are many types of supplies. For example, you have supplies on the standard rate, you have mixed supplies, you have progressive or periodic supply, you have a concept of deemed supply. We just mentioned this in the case of insurance claim. There are excluded supply. Excluded supplies are not exempt supply. Exempt supply is something there was a tax, and the tax was specifically excluded. That is called exempt. But something which never comes into the tax net, that is not called an exempt supply. That will be treated as an excluded supply. Then there is zero rate supply, exempt supply, deferred supply, incidental supply. We'll try to discuss most of them. Now, standard supply. In your case, it is a VATable supply, standard rate 5%, and input VAT that will be claimable against your output liability. That's a straightforward. Zero rated. Zero rate supply is by all means a taxable supply. Only the rate is zero. That is why it is called a zero rated. So anything that is measured against a negative balance will basically accrue you refund. So basically whatever input VAT that you pay against a zero rate supply will be claimable to you as a refund or carry forward balance. Then there is a concept of exempt supply. VAT is not charged. And of course, if it is an exempt supply, therefore no input VAT is claimable on that particular supply. For example, it is proposed that education, healthcare, staple food is exempt, therefore no VAT will be claimable. That means you will be able to see, if you compare the second and the third one, where it is always better to be in a zero rated regime rather than being in an exempt regime. Because in an exempt regime, you will not charge any VAT on your sale. However, the price of that particular good will invariably be higher because it must have attracted some sort of VAT on its input, which was not claimable. Whereas in the case of zero rate, so basically exempt goods are partly tax goods because they are on their purchase, on their costs. It has a built-in VAT as a cost. So VAT will be recovered as part of your cost, not as a VAT. So then there is a concept of mixed supply, a mixed supply of taxable and exempt goods. Again, if there, we'll discuss this later on, but if there is a supply which involves a taxable component and an exempt component, you need to apportion your claim according to your sales. That is called a mixed supply. There is a deemed supply we just discussed. There is excluded supply we discussed, and there is a deferred supply. On import side, on export side, particular categories, the VAT is deferred for some time. And some circumstances, some situations, the VAT officer is also empowered to basically defer recovery of VAT. So basically they are called deferred supply. Now there is a very important concept of time of supply. VAT is payable earlier of these three events, of these four events rather. Either you have delivered the goods, either you have issued the invoice, either you have obtained some sort of an advance against a particular transaction, or the due date has become due according to the contract. Whichever date, whichever events occurs first, you will be supposed to pay VAT on that particular time. So time of supply is very important, and in the later transactions we will see how it will have an accounting impact as well. Then a value of supply. What will be the sale? If I have sold goods, what will be the value? So basically, VAT is charged on every supply by reference to the value of supply of such goods. Now, there could be situations. You can have a money consideration, you can have no money consideration, and you can have a partially money consideration against the supply that you have made, against your goods, against the goods that you have sold or against the services that you have rendered. There can be varied proportions, varied models for this. So now we understand that there are three elements: the supplier, the recipient, and the consideration. And the consideration could be in cash or in kind as well. Now, if the value of supply is in money, whatever is agreed between you and your buyer is the consideration for VAT purposes. You will just multiply 5%, you just apply 5% on that particular X and get the output VAT. Where there is no money consideration, or there is a mix of money and barter. There could be a barter transaction and there could be an element of partial barter transaction. Then there will be an open market price concept, and the open market price concept says that it will be assessed to VAT on that particular amount which a similar supplier would generally fetch if supplied in similar circumstances. So there you see, there are now we are examining the judgmental areas, the subjective areas. What is a similar supply? What will be that similar circumstances? So basically, all VAT laws basically have these sort of provisions which basically trigger litigation one way or the other, because the VAT officer or the tax administration take a particular view with which you may not agree. So these are the areas where we find a lot of litigation here and there. Now, the straightforward, this is the most simple formula for VAT. You minus your input VAT against your output VAT, and whatever is payable you give it to the tax office or claim it as a refund. In the first place, you see against a 20,000 VAT output, you have two different inputs, 7,000 and 10,000. The net liability is 3,000. Whereas it's the other way around, the output VAT was 10,000 and the input VAT was 25,000. That means you have basically come up at a refund. How this is done? This way. The timber company sold raw material to the furniture maker, charges VAT, and pays the VAT to the tax office. The furniture maker sells this to the retailer, charges VAT, and pays to the VAT office. The retailer sells to the consumer and pays to the VAT office, and it is the consumer who is supposed to bear the burden of all the VAT. He is the consumer, he cannot claim anything from the government. Now, how the standard VAT regime works. Now, whatever the supplier charges from the utility companies, at that stage the supplier claims back from the government. In the second stage, the utility company claims from the government, and in the third stage, the consumer pays, but no claim is there for the consumer, as we just mentioned. So this is basically the standard rate works. You charges VAT from the buyer, and the differential is paid to the government. Again, this is the zero rated. You charge VAT at 0%. Whatever you pay on your purchase, on your import, on your services, whatever goes into the making or sale of a zero rated supply or service will be claimed from the government. For example, in this particular case, it is, for example, sold in a free zone, so that will be, there's likely to be a zero rated zone. Therefore, all the VAT that is suffered on procurement or imports will be claimed back. And again, lastly, if it is an exempt supply or exempt service, whatever you pay in the taxable activity of an exempt product or service will not going to yield you the refund. So basically, these are the three types of tax structures in a VAT law. Now this is basically how, in a fully taxable business, how things work. The cotton manufacturer, the cotton farmer, it sells for $1,000 plus VAT to the clothing factory. 5% VAT, $50 is your output. The clothing factory sells to the clothes shop as 2,000. His output was 100. The input was 50. 50 is now balanced. The balancing sum is paid to the VAT office. The clothes shop sells to the consumer, applies VAT. 3,000 was the price. The VAT comes to 150. His input was 100. 50 is now goes back to the exchequer. The consumer bears 150 VAT plus 3,000. So basically, it is the consumer which will bear the entire burden of VAT in a fully documented supply chain. Whereas, in the case of an unregistered, I am not sure because the law is not with us, we are not sure, but in, for example, in UK, for example, in Pakistan, there is additional VAT on a person who is liable to be registered but is not registered as such. For example, in your case, it could be 7%. The normal rate, if you supply from a registered person to another registered person, it could be 5%. If it is the goods are supplied from a registered person to a person who is actually liable to be registered but not registered, the VAT rate could be 7% or 6%, something like this. So in this particular slide, you see the cotton farmer again sells to the clothing factory as 1,000 plus VAT. The output is $50. The clothing factory sells to the clothes shop, but that is an unregistered shop. So basically, against 2,000, there will be a standard VAT rate plus additional VAT. For instance, it could be 150 instead of 100. So the net liability will increase by $50. Therefore, the consumer will have to pay 3,150 as against 3,000 previously. Now, if you have issued an invoice, you have sold something, you have issued an invoice, and in the later stage, you also filed your VAT return. Now you want to do some adjustments. Now you want to revise the invoice, or you want to revise your VAT return. There is a possibility, but there is a mechanism attached to it. There is a mechanism of debit and credit note which can only be issued in the following cases. If the supply is cancelled, for example, the order was cancelled, the contract was cancelled, both parties will exchange the debit and credit notes and will accordingly incorporate this change in the return. There was a return of goods, there was a change in the nature of supply, original supply, there was change in the value was probably 100 riyal and you charge 150 riyal, so there will be a need to adjust the 50 riyal element or any other event. On the basis of these documents, both parties shall adjust their VAT liability or credit in the period in which the notes were exchanged. That means tax invoice once issued cannot be reissued, and this we'll discuss later on. It cannot be altered. It cannot be reissued. It cannot be modified unless and until it is basically backed up by these specific provisions which every VAT law will cater. Now, we just mentioned that your input VAT is adjustable against your output VAT. What if the differential figure becomes a refund? Before that, it will be interesting to see how you can claim the credit. VAT paid, this is a general law. Every VAT jurisdiction, the law remains the same. If you have paid a particular VAT on goods and services used in the making of a taxable supply in a taxable activity, that is claimable. You can claim the VAT. Then if the output VAT increases, if the input VAT is higher than the output VAT, either you can claim a refund or you can carry forward that particular negative balance to the next tax period, where it will be clubbed with the input VAT for that period, and the consolidated figure will be adjusted against the gross VAT liability, and it will be determined like this for a particular time afterwards, after which it will be claimable as a refund. And generally, you cannot claim input VAT which is used in making exempt supply or supplies which has no nexus with the taxable activity. These are all principle based. You see, there is in a VAT law, the difficulty is that it works on a principle based. It doesn't work on a rule basis. So if there is a rule, well, you can claim this, and you cannot claim this, then there will be no problem. Instead of defining a rule, the VAT laws generally lay down principles. So it calls, whenever you compute your VAT liability, it will be a judgmental factor. And we'll have certain examples to basically demonstrate this particular idea. Then apart from these principles, there are certain VAT inputs which a business cannot simply claim. For example, VAT that you have paid on passenger vehicles, entertainments, this is not claimable in most of the jurisdictions. Then of course we just mentioned VAT that is not connected with the taxable activity, VAT for which you do not have a valid tax invoice or a valid customs declaration, VAT tax invoices that have not been deducted from output VAT within a stipulated time. In many VAT laws, there is a time frame attached to it. For example, in your case, which is likely to be, you are likely to have a quarterly return. For example, you paid some VAT in January, and which you ought to have been claimed in March return. You forgot, or by any means you couldn't claim it. So there will be a time aspect. For example, succeeding 3 quarters, succeeding 2 years, 2 months, etc., etc., wherein you will be entitled to claim your unclaimed VAT. Afterwards, it may become a time-barred situation. It may be foregone. So, tax invoices that have not been deducted from your output VAT within a specific time, that will not be claimable. Then claims on tax invoices that have been issued prior to the commencement of liability to VAT, again, there is a transition period. I hope that your VAT law will cater to these stipulations as well. Then VAT paid on journal fixed assets or goods of journal nature that may not be claimable against your output liability. Issued VAT passed on to you from non-active taxpayers who are not regularly filing their returns, who are non-compliant taxpayers, they may be discarded, they may be classified as non-active taxpayers, and of course you won't be entitled to claim VAT passed on from them. Then again, VAT on purchases or of goods or services where the corresponding party, where the supplier of goods or the service provider did not offer that particular transaction in his VAT return. So that may also be not claimable to you. Now, when we discuss this, that it is basically a judgmental call. What can be claimed, what cannot be claimed. Here are certain examples which can be claimed. Raw materials consumed in manufacturing of a VATable product. On the product, you will pay an output VAT, therefore you will be able to claim input VAT on the raw materials out of which your product was basically manufactured. Then electricity bill of an oil company, claimable. Utensils purchased by a restaurant, of course, relating to its business activity, claimable. Delivery trucks imported by a furniture distributor, that can be claimed. Crane purchased by a logistic company. Cartons imported by a courier company. Of course, the courier company would be paying tax on all the deliveries. Therefore, the cartons become an essential part of its taxable activity, and VAT paid on cartons may be claimable. Packing materials imported by an importer, yes, claimable, zero rated, we just mentioned. IT software purchased by a telecommunication company. Machinery imported by a textile mill. Customs agent invoice to an importer. Of course, the importer would have imported something, and the customs agent would have rendered its services for clearance of these goods. So all this will be claimable. Insurance premium in respect of plant insurance and repair maintenance of air conditioners by mall management companies. So basically these are certain examples that have been deduced from the principle that we have just discussed. Then there can be inadmissible VATs. Based on the identical principle, there can be inadmissibilities as well. For example, tissue paper purchased by a furniture manufacturer for his own use, tea refreshments served to customers we just discussed, and expenses on entertainment are not claimable. Card purchase for company CEO, renovation of director's office, calendars distributed among employees, laptops purchased from an unregistered person. This is very important. An unregistered person who is not registered, who is not on the VAT record of the tax authority, is not entitled to basically issue any tax invoice. And if he can't issue a tax invoice, you cannot claim the associated VAT. Paper bags purchased by a hospital, again, very important concept. Hospital is basically an exempt sector. So whatever it pays, whatever expenses or assets that it basically procures, it's not going to claim any sort of VAT because it has no taxable activity as such. Then VAT invoice of lubricant wherein VAT is not separately disclosed. This is again very important. You are into a taxable activity. Your supplier was also a taxable person. VAT was duly claimed, but he was supposed to disclose or report VAT separately on his tax invoice, which he didn't. So since he did not, it was clubbed, the VAT was clubbed in the overall price of the product, you will not be entitled to claim VAT. These are the peculiarities we were just discussing in the earlier session as well. Now, partly recoverable VAT. If you are into an exempt business, you cannot claim. But if you are into a business that is partly taxable, partly exempt, you can claim if it is directly, if the expense is directly related and identified with the exempt product or service, that is not claimable. If it is directly attributable to taxable product or service, that is claimable. But if it is in between, you need to prorate. Proration will be made on a specific formula. Proration will be made on the basis of your taxable turnover, total turnover, vis-a-vis your proportion of exempt turnover. For example, you are a distributor of chemicals, and you are a distributor of pharma products, medicines which are exempt, and you basically store both these products in a warehouse, in a single warehouse. So whatever, for example, if you are paying rent of that warehouse, or if you are paying electricity bill of that warehouse and VAT thereon over and above on that electric bill, you need to prorate your credit, because that particular electric bill relates to your consumption, your business activity of taxable goods as well as exempt goods. So you need to prorate your credit as well. Now we move on to the statutory obligations. These are various legal responsibilities that the compliance side, which is associated with the VAT law. You need to have a registration, then you need to make payments, you need to file your returns, then you are supposed to VAT audits, etc., etc. So basically what I just mentioned, who is a taxable person or registered person, who carries on a taxable activity and is registered or is required to be registered. He is supposed to be a taxable person. No other person can be called as a taxable person. As far as registration is concerned, we just discussed that up to there is a concept of voluntary registration and there is a concept of mandatory registration. Up to 375,000 or more, up to 375,000 Riyal, it will be a voluntary registration. You may opt, you may not opt. And beyond that, it will be a compulsory registration. You need to register. And if you do not register, you will be exposed to penalties. Again, we discussed this, that group taxation has been left to the discretion of member states. There could be a situation that any member state may opt for group taxation, and whereby the subsidiaries or the various components of that group may be able to offset their liabilities against their refunds, and in some jurisdictions there might not be any such situation. So it will basically depend when the law is out for general public. Now VAT invoices. VAT invoices are required to be issued generally at the time of supply. But here in the directives that we just mentioned, it has been laid down that time of issue and invoice will be decided by the GCC member countries. So in one particular way, in one particular state, it could be that an invoice needs to be issued at the time of supply. For example, if you have obtained a particular advance from your customer, that will be treated as a supply and will be exposed to VAT, and you will need to issue an invoice there against. In another country or another state, it may be different. It may say that what it will basically corroborate with your policy of revenue recognition. If your revenue recognition policy is on delivery of goods, you might also be asked to basically issue an invoice as per your commercial terms, not in accordance with the VAT law. So basically it will depend. how a VAT invoice will look like and what are the ingredients of those invoices. You see, VAT invoices are basically called, they are equated to checks, because as against checks, you are entitled to some money. In VAT invoices as well, you are entitled to the refund of associated VAT. So if there is a discrepancy, if there is a there is a lack of harmony vis-a-vis what the law says according for the invoice format and the actual format, there could be a problem in claiming the associated VAT. So if you see on your screen, these are the mandatory features of a tax invoice. There's a name and address of the supplier, his VAT registration number, description of goods or service. There's a separate VAT, as I just mentioned, there has to be separate disclosure of VAT. Then value inclusive of VAT, value exclusive of VAT, VAT registration number of supplier and buyer, etc., etc. After the issuance of invoice, the second important area which needs to be complied with is your VAT return, then payment of due VAT, and if you are resulting in a VAT refund situation, you need to claim that refund separately. Now, in case of VAT returns, in the directives that has been issued by the Gazette this month, it says that it could be a tax period, could be a month, could be more than a month. We generally understood that ever since we have been discussing VAT in the GCC countries, we have been listening that it will be a quarterly return. So that means the tax period will be a quarter. So if it is a quarterly return, it could be monthly return. For example, in Pakistan, it is a monthly return concept. So you have 12 tax periods and 12 returns need to be filed in a particular year. So in case there is a quarterly return issue mechanism, the deadline for submission of VAT return may be during the month following the end of the VAT period. For example, in the case of quarterly VATable periods, the deadline for submission may be the 21st day of a month following the end of the quarter. For example, if March is a quarter, you may be asked to file VAT return on 21st April. So that will be the due date for filing. These are generally record keepings for VAT purposes. You need to keep track of your VAT returns, VAT challans, GL account, we'll discuss it later on, inventory record, stock reconciliation, sales register, credit notes. Again, you will recall, I just mentioned that whatever changes you need to make in your sales invoices or VAT return that have been filed with the regulator, then there is a mechanism of debit and credit note. You can only make adjustments, post-supply adjustment through these notes, otherwise not. You cannot alter the reissue the invoice as such. Then there is a purchase register and debit note, purchase invoices, goods declarations or bill of entries, utility bills, bank statements, deposit slips, GL for advance from customers. Again, I just told you that in case you receive advance from your customers, that will be equated as sales. So you will have to basically keep a separate GL for your advances that you receive from customers for production of first of all calculation for accurate VAT liability, and again for audit purposes whenever VAT officers come to your place. And there is a reconciliation with sales as reported in the VAT returns, gate passes, VAT refund acknowledgement. If you have claimed refunds, you need to have evidences to show this. Then sale purchase agreements and other contracts, export documents, record of costing, wastages, scrap. These are very important. These are very important documents. For example, if I just share with you, for example, you sold a particular pointer at 100 Riyal, and the tax officer, if the tax officer believes that you ought to have sold it not below 200, So while disputing your value for VAT purposes, he may call for the costing records so that he may ascertain the cost. If the cost, for example, according to him or your record shows that it is well ahead of 100 riyal, then of course he might question that when the cost was even higher than 100 riyal, how the hell I was able to sell it to 100, I could fix my price below 100. So basically these are the areas which will trigger at the time of VAT audit, or where there are disputes regarding the value that was offered for VAT purposes. Then of course wastages, audited accounts, or any other statutory records required under any other law of the land. For example, again taking clue from that particular example, to arrive at your cost, he might ask you to produce a particular statement or declaration that you need to file with social security agencies or Ministry of Labor to support your wage component or cost. So he basically may also place reliance on all those documents to basically calculate your own sale price, or to ascertain the price that you offered in your returns. So these are important concepts. This is a sample VAT return, and I would say a simple VAT return, because in practice it may be complex. In the first box, you need to pay VAT on your sales. Then of course VAT due as a reverse charge you need to pay it. Then the third box is total VAT due. Then you have VAT which you reclaim on your purchases or imports. Then there will be a net liability which you pay to the customs or the VAT regulator. Then there is a column for values. What will be the value? What was the value of sales? What was the value of purchases? What was the value of goods or services that you basically offered for reverse charge purposes? So it may be complex. It can have so many pages and so many boxes. This is the simplest one that you are just watching. Now, again, VAT will be paid if you are importing at the time of clearance of goods, or at that is on the import side, and if you are selling, then at the time when you are filing your VAT return. Now, if you end up in a VAT refund, now if you end up in a VAT refund, what sort of refunds that are available, generally available? Number one is, we discussed this, that all exports will have VAT refunds, because there is no output VAT liability. Whatever you pay, you will claim as refund. That's the first part. The second part is that excess of, if you continue to arrive at a negative balance, every time your negative balance is there, your carry forward, you result in a credit balance, then after a particular time, the unadjusted credit may be awarded to you as a refund. For example, if the VAT, if you continue to arrive at a VAT credit for 12 months, for example, on a regular basis, at the end of 12 months, you may be honored with cash refunds against your VAT credits. Then again, VAT not claimed in the tax return within the relevant tax periods. Again, if we just mentioned that the law may say that, well, you will not be able to adjust a particular VAT which you did not or you could not claim. You need to file a separate refund for that, so it will be a cash refund. Then refunds to diplomats. Again, there are agencies, there are laws all across the world whereby NGOs or United Nations organizations or organizations like this, they are entitled to VAT. So if you supply them, though this is a local supply, you can have a VAT refund in your credit. Then excess tax paid by the taxpayer by way of inadvertent. There was no VAT, for example, or there was a VAT of 5%, you paid 7%. So whatever excess you paid, or whatever tax that was not payable, you paid to the exchequer, you may get it by way of a refund, or the refund that arose as a result of an appellate order or a court order. I'm not sure what will be the appellate system in VAT in Saudi, but at least to my understanding, there will be a 3-tier appellate system that is the minimum in any country, whereby adverse actions or adverse orders conveyed to you by the tax regulator may be appealed against. Then there is a concept of VAT audit. There is a routine audit which the VAT regulator may undertake any time. In that particular audit, they can ask you to file returns, they can ask you to file records, etc., with their office. Then there is a concept of desk audit or analytical audit. They do not, because all the tax returns will be on electronic mode. They will not call, they might not call any specific information from you. They will just analyze your returns. They'll cross-verify with your supplier's returns, and they might end up in some observation or something against you, and they will basically, so this will be an analytical audit that they might conduct. Then there is a refund audit. Whenever you file a refund, it will be paid to you after an exercise, after verification, which we call as a refund audit. Then investigative audit. This is basically where the authorities believe there is a fraud element, and its scope is much wider than that of a normal VAT audit. They might ask you to prove the sources and application of funds, etc., shareholding, etc. And there is a concept of forensic audit in VAT laws as well. This is basically conducted by accounting firms, generally, or forensic experts. For example, in an oil company, they might constitute, the VAT regulator may constitute a forensic team comprising of chemical engineer, an accountant, a tax lawyer, or something like this. So basically, this can be a club of many people who will basically do your forensic audit. We just mentioned if after the audit the VAT regulator is of the opinion that you did not comply the law in the manner you are supposed to do so, he might serve you a show cause notice to explain your viewpoint, and afterwards that particular notice may be converted into an assessment order. And if you feel aggrieved, you feel that this was not, he was being unjust with you, you can file appeal against the order, and there are, as I just mentioned, at least 3 tiers of appellate stage. The law is yet to come, so we do not know, but generally there are at least 3 stages of appeals in a VAT law. Then of course there is a recovery of VAT. The law may also provide timelines within which an adverse demand of VAT that has been created against you may be recovered from your bank account or by the tax regulator. This will also be seen when the law is out for general public. Now, what are the exposures of being wrong? VAT is something in which it's a unique law in which your particular information may be gathered without informing you. The tax regulator may serve a notice to your clients, to your customers, to your vendors, and may ask for specific information. Your business transactions may be unearthed. If you do not comply, then you can be in trouble. For example, apart from penalties and surcharges, etc., on account of non-payment, what can be done is that your imports may be blocked. If the VAT office believes that you are a tax defaulter, you have not paid tax despite demands created on your account, your imports may be blocked. Your future, you will not be able to clear your imports. Number one. Number two, your VAT registration number itself may be suspended or blacklisted. That will mean that no one will be able to supply you, and likewise you will not be able to sell your goods, because whenever someone supplies you and he inserts your registration number on his website, he will basically get a message on the website from the VAT regulator that this particular transaction is in danger, that particular party, that particular unit has been blacklisted or suspended. Whatever you supply, you will not be able to claim your input VATs. So of course no one will basically take this exposure, and your suppliers will be hesitant to supply. And likewise, if you supply your goods being a suspended taxpayer, your invoices will not be honored for VAT refunds or carry forward or adjustments. So therefore your sales and purchases both will be in trouble. Then again, without letting you know, your customers may be served notices by the VAT regulator asking them to pay such and such amount of VAT directly to the VAT office instead of paying to you, your debtors and creditors. And of course, your bank accounts may also be attached straight away by the VAT regulator to recover the alleged amount or the demand framed against you. So this is basically the VAT framework on local side. Now there is a little bit on the international trade. VAT on international trade, as we just mentioned, works on a destination principle. What is the destination principle? It is divided into two parts. The first one is on goods, the other side is on services. What is importation? Importation includes bringing goods into the country from outside by any person. You're importing, that means you are into international transaction, and VAT will be levied according to this framework. Now, import side may be divided into two areas. We just mentioned there is a deferment concept of VAT as well. Either there can be only two situations. Either there will be a VAT, levy of VAT and collection of VAT, and there could be a deferment of VAT. If there is a deferment of VAT, what will be the situation? The situation will be temporary import, same state. You imported this pencil and you will export this pencil as it is without making any value addition. It will be trading. So if you have imported something which will be re-exported in the same state, there could be two situations. Either you will basically clear them, you will get the consignment cleared by making payment of customs duty and VAT, or you will basically obtain a warehouse. It will be called a warehousing, where you can keep your goods in a warehouse and get them cleared on a need basis. Therefore, you will not be exposed to pay VAT on a lump sum basis. It will be paid on a just-in-time basis. Then, of course, this particular, as against immediate clearance, there can be warehousing situation as well. This particular model may also be replicated in terms of in-house consumption. For example, you are importing a chemical and you will be basically manufacturing paint out of that chemical, and you will be exporting the paint. So in that, it will be called an in-house consumption. You will consume that that chemical. So if it is for re-export purposes, there can be a situation calling for deferment of VAT. Now, if the VAT is not deferred, then you will have to make payment of VAT. Again, payment of VAT will be in three situations. Either you pay VAT and get all your consignment cleared in the very first instance, number one. Number two, you keep your goods in a warehouse, you defer your VAT. As you withdraw those goods from the warehouse, you pay VAT. So you will basically manage your cash flow according to your sales, according to your consumption pattern. So in that particular case, you will be exposed to pay VAT to the extent of the goods that are cleared from the warehouse and not the goods that were basically lying intact. And third thing is that switching of bill of lading by the exporter. There can be situations where the bill of lading may be, for example, the goods were meant for Mr. A, but during the travel, the exporter wants them to be consigned to Mr. B. So in that particular way, there will be a switch of bill of lading, and the person in whose name the consignment will be basically recorded, or he will be named as consignee, will be exposed to pay VAT. Now, on the supply side, on the good side, that was the import side. Now the supply side. Exports, we just mentioned, is of course zero rated. Then sale to or within the free zone or special zone. There are free zones, I know in Saudi as well. There are special zone in UAE. So the draft, whatever the features that have been made available to the public, they say that goods that are transferred to the economic zone, to the free zones, or goods that are basically, they move within the free zone or the economic zone, that will be free of VAT. But once they get out of that, they will be exposed to VAT. And again, there are certain local sales, but they are equated with zero rating and no VAT is charged. For example, if you supply some food or some provision aboard a flight, for example, going abroad, so all these supplies will basically be exposed to zero rating VAT. So basically now we need to understand what is the free zone. As I just mentioned, a special class of special economic zone that is seen outside the GCC for tax purposes. For example, for VAT purposes, free zones in Saudi will be seen as territories that are outside the GCC framework. As such, goods coming through the free zone will not be VATable until they leave the free zone for clearance, and import VAT will only be due when the goods are cleared for customs and leave the free zone. And again, as I just mentioned, there will be no compliance requirement when these goods move within the free zone. This is basically the example. Now we move on to services. Again, services performed outside Saudi, leased licensed goods outside Saudi, services connected with temporary imports. These are the areas where you can have a zero rating situation. In zero rating, there will be different treatment for B2B and B2C. Of course, in B2B, you will be exposed to reverse charge, and the reverse charge is basically defined here. In case where registered or taxable person in KCA receives VATable services from a non-resident person living in UK, such service will be assessed to VAT on a reverse charge basis in the hands of the recipient and subject to VAT in the same manner as any other importer would be suffering. So this basically ends the theoretical part of VAT. I'm afraid we are short of time, so they will be moving very quickly with the practical side. What are the roadmaps? What are the implementation plans that are required for effective implementation of VAT? I'll discuss this. Basically, you need to understand, you need to take into account the plan. Number one, how do you, this is basically the area where I suppose you will be interested the most. What is required? What are the responsibilities for implementation? Who is responsible? Do you have appropriate resources, human and technical? What is the budget? What system changes are needed? Have you taken cost and cash flow analysis? You need to create a project team and governance to manage the implementation. And for this, you need to undertake an initial review. How will VAT impact your business? You need to define your strategy. And of course, you need to work back from January 2018, if it is to be there by this time. So there are many steps. There are 4 steps. Number one is people. You need to set up implementation team. And who would be in the implementation team? Could be logistics, procurement, sales, finance, IT, or everyone. There should be right people involving all stakeholders. Then, of course, there should be people with budget. There should be budget holders. There has to be a governance responsibility, and sourcing of resources is very important as far as recruitment and training or upgrading of skills are concerned. Then, in the next stage, you need to evaluate the business impact, review the business and tax environment, how they may accommodate VAT, including tax strategy and governance, business operations, finance and tax functions and processes, skills, roles and responsibilities, risk management, control and control processes. Of course, technology has a very deep say into all this. Then, of course, planning, budgeting, and above all, what is the reputational risk if you go wrong? Then you need to, in terms of supply chain and in terms of sales, you need to take into account what are your suppliers, where do they belong, what is the cost of VAT. Of course, you need to also take into account what is the cost of the irrecoverable VAT. What is the VAT component that will not be admissible to you? Because 2 plus 2 is not always 4 in VAT. So there would be situations where a particular VAT or many VATs will not be claimable. So you need to understand. And of course, what impact will it have on the profits? Then transactional VAT issues, we understand they will be in the law, but since the law is not before us, we cannot really comment, but we need to understand what VAT implication will be on the existing and future contracts, asset purchases. Then, of course, you need to understand the tax planning and fraudulent tax practices that will be there invariably. Then you need to test drive overall VAT commercial chain before going live. You need to quantify increased administrative cost. You might need to appoint a VAT manager to basically look after all these compliances. And in appointing this, you may outsource or you may have an VAT management inside and of course your P&L impacts. A specific consideration, again, as I just mentioned, liquidity impact is very important in case your refunds are not honored on time, and of course irrecoverable VAT computation in calculation of your export orders. That will also have a very strong bearing especially if you are bidding. Then of course you need to be competitive and take into account these areas. IT, the third one is you need to assess your IT, customer and suppliers platforms, financial systems, filing requirements is very important. And we were just discussing this in the morning. There is a concept of e-invoicing, whether businesses will be allowed to issue or maintain e-invoicing. Yes, in some jurisdictions they are allowed, provided they are serially numbered, etc., and retained for a particular time. Your model, which basically the system model, should be able to be a VAT compliant, have correct VAT coding of accounts payable and receivables, internal controls. Your system should be able to raise invoices, report VAT, and how robust you need to understand, because any system failure or any error will basically cost you much. As far as the technical and governance is concerned, you need to focus on external sales, intra-company sales, VAT clauses in contract, accounting and accruals. All contracts need to be, at least the existing contracts, when the VAT is in field, you need to basically review all the existing contracts because they will have a VAT implication. And as far as governance model is concerned, you need to identify the roles and responsibilities. Risk manager, of course, is very important. Cash flow, we just mentioned with Irfan suggesting some valuable tips to the CFOs. So before, then you can go live if all the stakeholders are there. Now, since I'm short of time, I've been told, I can probably easily come to the common pitfall. This is very important. What can go wrong and why and where things can and may not work according to what you believe. You can apply, this is for the business. This is for the business. You can apply incorrect VAT rates. You can omit your sales. You can have invalid or missing documentation. You can have errors in calculation of VAT. There can be clerical or system errors we just mentioned. You can omit your intercompany transactions. The JVs can be incorrectly posted. You can have manual corrections which may not be allowed. Transaction outside the system, very important. When the purchase is not recorded, the corresponding sale will also not be recorded. So there is a system, parallel economy, what we call, and there can be control checks and balances issues. Now, you have not seen a VAT regulator, and you have been fortunate enough, because in our part of the world, we have a very different and a very complex tax management in place. Now, what and why the regulator can go wrong? Number one, there can be interpretational differences between business and the regulator. You interpret the law in a particular way, the regulator may interpret the law in a different way. Then, again, as I just mentioned, you can have a particular liability framed against you on the basis of third-party information. Not on your record, not on the basis of your own record. They can have your information from the vendors, from other regulatory agencies, from your customers, from your clients, and they can frame a particular liability against you. Then, of course, this is very important. Revenue targets override equitable enforcement of law, enforcement of taxation. You see, they have their own targets. So when the targets are not met, the equitable enforcement evaporates. So they become you see, complex. Then again depends what is the tax accounting model conceived by the tax regulatory system itself. Then of course there is a parallel level playing field, absence of a level playing field. Your competitor is unregistered, you are registered, how can you compete? Then the last one is the perception and trust gap. Unfortunately, the tax regulator believes that you are not being honest and vice versa. So there is a trust gap that will remain there. This is basically the VAT accounting. It is not different, not difficult. You need to pay on accrual. These are various entries. I can share these, you can circulate the soft copy. These are, can I have 5 more minutes? Okay. So I'll just try to wrap up with the 2 more slides. VAT accounting specific issues. You're fortunate enough that you do not have separate regulators for goods and services VAT. In Pakistan, we do have, in Canada, they do have, in Australia, they do have national and subnational VATs. So therefore, there is an overlapping. A tall manufacturing may be classified as goods, or tall manufacturing may be classified as service. So if there are 2 different regulators, 2 different returns, 2 different laws, where to park your basically transaction according to VAT. So there could be an accounting issue as such. Then overlapping of services itself. For example, you are making a program. The law may define it as a program. The law may define it as an advertisement. The law may define it as a documentary. So there could be situations where by virtue of the definition of service, there can be categorization, there can be overlapping. So in accounting, you need to be cognizant of these facts. Then revenue recognition, very important. For example, if you are receiving advances from your customers, in your sales, in your VAT accounts, you will need to record this as sales, because VAT is recorded at the earliest of 4 events. Among them was a receipt of advance. So whenever you receive an advance, it will be recorded as sales in your VAT accounts. Whereas in your accounts, in your financial accounts, you will record this as advance from customers as a current liability. So wherever you receive advance, that particular transaction or those transactions to the extent of those transactions, your VAT records and your financial records will not match. So therefore, you will need to have reconciliations in place. Then there is an origination and termination. We discussed this. All VAT's inputs are on destination basis. Provision for contingent liability, you may be asked to provide for a liability that is sub judice, that is under litigation. Then reimbursement of expenses as part of sales price. There could be a situation where you will try, or business may explore the possibility of separating its price and the cost, so that the cost may not attract VAT. In certain laws, it is acceptable. In certain areas, it might be acceptable. You need to tailor. So as far as the VAT law is concerned, you will have to tailor your accounts to that extent so that it may be a tax beneficial transaction. Then of course, in case of imports, if there is a particular value assigned to a particular product by the customs and your actual value is different from that, therefore your imports, the value of imports in your accounts and your VAT records will not match. So it will be a reconciling item again. Then again, provision of stock, provision of obsolete slow-moving stock, you might provide them, you might create a provision against obsolete stock in your accounts. However, there is no concept of a provision in VAT laws. So to that extent, your financial records and your VAT records will differ. Your VAT records will say that the goods are available, whereas there are no more in the financial records. So now, lastly, I need to move fast. Now, this is the last slide, practical business issues. Now, what VAT claimability on a stock as on 1st January? I understand there will be some provisions, saving clauses, whereby you will be entitled to claim VAT on goods which will become taxable on 1st January 2018. There will be a built-in some sort of VAT that you must have suffered by one way or the other. Now, then second thing is discount. What is the industry practice, general industry practice? Discounts are those discounts which are, according to the general industry practice, they are deductible from VAT. So the net price, net value is offered for VAT purposes. But what is general industry practice? This remains a matter of interpretation. Then of course, self-consumption, you will be exposed to VAT on self-consumption. Joint liability, several liability. If your supplier doesn't pay, you might be exposed to VAT as a recipient. Then there is no concept for replacement of invoice. As I just mentioned, if the invoice is not there, how you are going to claim the VAT? What are the alternates available? Double taxation, of course. If some foreigner comes here, for example, I reside in Carlton, and at the time of my checkout, the hotel hands over its bill to me with a VAT levy of 5%, and the bill has to be settled by my firm in Pakistan. So it's going to be double taxation. One taxation is which is evident on the face of the invoice, and other that's going to be as a reverse charge principle. So there could be situations of double taxation as well. Then there's the concept of mixed supply, exempt and taxable. If a particular exempt supply is used in making of a taxable supply, the entire product becomes taxable. But what if it is the other way around? If a taxable product is consumed in making of an exempt product, then most likely at that consumption point will be a tax point for VAT purposes. You will need to pay tax for that particular consumption. Then transfer of goods to you have your own shops, you have your own branches, you have your own outlets. What are the mechanics by which you can transfer goods without paying VAT? Because it can be inferred by the VAT. If there's nothing in the law, it can be inferred by the VAT regulator that they were basically sold out to the third party, not to your own branches. Then integral part concept, very important concept. The VAT regulator may also, because again it is principle based, you will have to define how far a particular input was essential to your output. You cannot just say that whatever I'm incurring is business expenditure and I'm supposed to get credit for all those expenditure. This is not possible. So you have to account for each and every transaction in a manner as laid down in the law. Then reverse charge as input. I just mentioned with Shadi, he was of the opinion that it should be claimed. Well, in certain jurisdictions, it may be claimed on services. In certain jurisdictions, it is not claimed. Lastly, there is a concept of a service provider, but there is a concept of service arranger. You might be facilitating for someone by arranging different services and renting from your own office. So there is a concept, if you are not a service provider but a service arranger, you may be exposed to tax. It will be seen in the law. So, ladies and gentlemen, that brings an end to my presentation. I'm not sure if I'm able to have questions. No. Thank you very much.
Thank you very much, Adnan, for a detailed presentation. Sorry for cutting you short by 30 minutes. But of course, it's a very long day and a very patient sitting for all. But we enter into the last 15 minutes of this full day symposium. Now I will call upon Mr. Syed Asif Zaman, who is the president of ICAP UAE chapter, to cover the cross-country treaties of the UAE, of the VAT. Mr. Asif Zaman.
Hello. Yeah, good afternoon everyone, and I will not take your time. Already Mr. Adnan have gone through all the details, and as the topics is there, this highlights of GCC treaty and the reason for implementing of VAT in GCC. You know that GCC from the day one, the main attraction for GCC was there was no tax or zero rate or very low taxation, and so many of us have moved over here because there is no taxation. And all of a sudden now we find that taxation is coming over here. It is falling, the taxation is falling us. So anyhow, I will be making a skip and giving you a brief idea of GCC VAT treaty. In recently just they have already published a GCC VAT treaty which covered the 6 GCC states, and they are trying to make a uniform rate of tax and some common laws which will be required for every GCC country to obey in this GCC treaty, and rest they will have their own local laws. A common VAT frame, a GCC member state that agreed a common VAT frame for the introduction of VAT system in GCC, a treaty is formally announced. Upon ratification of GCC, each member state is expected to issue its own national VAT legislation on the agreed common principles. There are some agreed principles in which there are some policies they all have to follow. Rest they have choices that whether they can make it zero rated, standard rate and exempt supply. In other slide, next slide, I'll be defining that one. There are 3 things. One thing is the GCC treaty, the framework under which each GCC country will have their own law. Apart from that one, the third one will be VAT legislation, which is executive regulation also. Executive regulation, if you are aware in Pakistan, like SROs. SROs are the one which will be defining specific events or specific transaction or specific industries. So you will have GCC treaty which is covering a framework, giving a framework to make the laws for each and every GCC country. Then every GCC country will make their own laws. Apart from there, they will be issuing executive regulations to more define the processes, how the VAT will be specific on a specific transaction for specific industries. Already Saudi Arabia and UAE have agreed that the VAT will be implemented from 1st January 2018 live. They have time duration that till 1st January 2019, all the GCC countries have to announce their own laws and executive regulation, and this implementation have to take place. So now we'll going that what is the reason for having a VAT in this part of the world all of a sudden, that what are the reason, what are the factors due to which this VAT have been implementation, and later maybe some more taxes will be implemented just to cover. Just look at these figures. These are the oil prices. All of a sudden you will see that oil prices went up to high to 147.27 barrel in 2008. That was the time when GCC was in full fresh and everybody wanted to move to GCC, Saudi Arabia, Dubai, because there is no taxation and there is a luxury of life, everybody is in good shape. All of a sudden then Gulf War prices started and the oil prices start dipping run. These prices went down. Today's prices is coming to $48.66 per barrel. Now how these prices are connected to the economy of GCC? This is very important, that what prices are affecting this oil prices. Basically this all GCC countries are hydrocarbon based. Their main revenue is oil, and apart from their non-oil revenue, they have a limited oil, non-oil revenue production. Now these are the figures. You see that there is a fiscal break even for these countries to achieve. If there is a deficit, they have to introduce some tax or find new avenues of revenues. Now according to IMF, the break even for Kuwait in 2017 first quarter is $47.8 per barrel, Qatar $55, UAE 60, Saudi Arabia 79.7, Oman 77.5, Bahrain 93.8. It's very high. And then you go back. What are the prices? The price first quarter 2017. And then if you go back, the price is $48.66 per barrel. And non-oil revenue is only limited. So there is a deficit in all GCC countries. How to manage these deficits? They are making plannings. Now one of that one is to introduce VAT. VAT is almost covering the deficit according to IMF from 1.5% to 2%, the deficit will be covered. Now see the deficits, the government deficits. You can see Jordan, Iran, Qatar in 2016 and 2017 the expected deficits. You can see all Qatar, UAE, Kuwait, Saudi Arabia, the deficit is -5, more than -5. And the revenue generated from the VAT will cover only 2%. So rest, there have to be some other revenues. You can see a GCC wide trend of 5% already due to implement in 2018. IMF estimates suggest that it could raise as much as 1.5 to 2% of GDP across the region. There is a plenty scope of other tax measures to help close this fiscal. For instance, GCC economy have long been able to spare worker as personal tax, typically major contribution to government revenue in high economies. So these are the report from IMF, which is saying that still after implementing VAT at 5%, maybe they will increase the rate or they have to implement if the government spending doesn't goes down. Now you can see that this is a chart. What is the current status in all GCC countries regarding the indirect taxes? You can see Saudi Arabia, there is already personal capital gain, profit tax, social security, dividend interest, royalties and business capital gain. And in all this chart, you will notice only UAE is the country in which there is only social security card on the nationals, rest there is no taxation. And the taxation 5% VAT is going to happen from 2018. So, but the deficit still is there. The oil prices expected, is going down, expected in 2000 it will be $53 per barrel. And from 2018 it is expected that the demands will go up because already OPEC, they have made an agreement, they have curtailed, Saudi Arabia already curtailed 6% of their production, which is 9.9 barrel per day. They have reduced their productions and supply. Now we are coming to GCC VAT treaty. Why GCC? There are some main factors and main points in GCC VAT treaties. In GCC VAT treaty, the mechanism is same as all Mr. Adnan have defined it. They have selected a system which is more or less EU. Why EU? Because EU is the only place which have a multi-country VAT system. Rest you cannot find anywhere else. But apart from that one, when it sees they have using the modern systems which is used in now Singapore and New Zealand. And they have introduced VAT. Why? Because the way to collect tax is a simple one and a proven one. All of the world, around 160 countries are using VAT as a source of revenue there, and it's around 7.5% GDP of the all the world revenue percentage. And it is easy to implement, and they have started with 5%, a low rate with less exemptions for zero rate and other things. So they have made it very simple. They are trying to make very simple start, because there is no, that in this part of the world, there is no proper documentation as compared to other part of the world. In Saudi, you have SOPA, the regulatory authority, but in UAE, you don't have any regulatory authority also. In Qatar and Kuwait, a similar situation there, that there are no documentation. The economy is not well documented. So they want to start with something which is very common and very easy and simple to be used. Now, the GCC VAT treaty already is, they have 78 articles and 15 chapters. In these chapters, definitions, number one is definition and provision as normal. Then supplies with the scope of tax, place of supply, date, due date, tax calculation, exceptions and importation, person who are obliged to pay tax, tax deduction, obligation, special treatment of tax refunds, exchange of information between member state, transitional period, appeals and closing provision. These have been defined, and after that defining you can find that on internet it's also available, that this GCC VAT treaty is available. Now there are some important thing in this GCC VAT treaty is that, yes. No, it is based in the sense EU that intercompany transactions are not taxable. It is on the one, and then rest there are some other things which is EU is not been using, and it's been taken from the modern tax VAT which has been used other part of the world in New Zealand and Singapore, the latest tax development. EU system, they have in the sense that inter-country transaction, because you can find inter-country transaction only in EU. In inter-country transaction, that already there is a common custom union law already implemented in GCC. If something have been imported in GCC in any country, the first part, like something have been imported in UAE, the custom, and then later it has to be transferred to Saudi Arabia, the custom duty collected at that point have to be refunded to Saudi. Same thing is they have adopted in VAT also. If some goods are been imported in UAE, and then later stages is for some reason they have to be transported they are in transit has to transfer in other GCC countries, whatever VAT is collected over there has to be transferred to that specific GCC country. Now there are some provision policies which are available to GCC countries. There are two important things. One thing is that this VAT group. What is VAT? VAT group is that one that each country have an option to combine a group of companies and single VAT entity. Means any transaction between this group country will not be subject to VAT. The authorities, the Ministry of Finance or the regulator have an option to make, you have declared a group as a single group of companies, they have an option to degroup you for some reason, or they have a reason to regroup you for some reason. These exceptions are there, like declare you have 5 companies in Saudi Arabia, and this group can only be inside a single GCC country, not a single country, not in inter-GCC. The group cannot be inter-GCC. It has to be in a single country located. Like that you have Almarai. Almarai have different production units. They are making something and they combine and that make a group. So they will register as a single tax as a one. And then some reason, if the regulator thought that there is a tax avoidance and they have combined some company which should not be in the group, they can take it out of the group. So the whole group will be treated as a single one. Any transaction inside between intercompany will be treated as a single unit, so there will be no VAT implemented unless you are dealing with the outside any organization. Now is healthcare, zero rated, education, real estate, local transport, you have option as per Article 29(1) GCC VAT relating exemption, zero rate or standard, you have the option to make it healthcare, education, real estate. Now the clarification is there already for healthcare. Like healthcare is almost to be exempt or zero rate, but if you are doing a plastic surgery, it will be standard rate. So only the life saving as part of healthcare, which is for essential, it will be exempt or zero rated. Other that one, cosmetic changes or something else doing, these are to be on the standard rate, which is clarification already has been arrived over there. In real estate is very important in this part of the world. You know, the real estate is the main backbone, especially in GCC countries and in UAE also. Already this UAE have already declared that real estate, for commercial real estate, it will be standard rate 5%. Residential will be first 3 year zero rated, and after that it will be exempt supply. It means the developer has an option to refund their all input which he have paid for the construction of the property, which is residential. And in residential, it's defined that it is of more than 1 year contract. Is a long-term contract, which is for short-term like 1 week, or it will be accounted as commercial one. Apart from local transport in only, you know, that clarification have been arrived in UAE, local transportation in UAE will be exempt supplies. Now coming to oil and gas, food supply and means of transport. Oil and gas, in GCC countries, only UAE have already declared that if you are filling a petrol at petrol pump, there will be VAT 5%. So it means the cost of transportation will increase, which will affect in all the products. So whatever you are thinking, if you are putting a VAT on a mean of transportation, it is always more than will be 5%. So if you are transporting, for example, a goods, there are 5%, then the means of transportation 5%. So ultimately the effect is more than the 5%. Food item also, they have declared there will be 100 exempt food item, rest will be on standard rates. Now exemptions to government body special organization as per Article 30. Some company relation international housing arrangement. Housing arrangement means that some companies like Emaar and Aramco, they are making housing in Saudi Arabia, or they are making in UAE, or UAE companies are making in for residential purpose. For residential purpose, they will be zero rated. Citizen member constructing home for their private room, yes, any GCC country, they are allowed to have whole land and make private home throughout GCC, so it will also be zero rated. Fishermen and then other. Now, in addition to that one, in EU, the difference which I was saying, in EU, you have tourists have an option, refund at the point of customer exit. In GCC, they have given option whether you want to do it or no, and UAE has already declared for tourists, it will be standard rate. There will be no refund. Now examples of policies of choice, financial services exempt or not waste. This is very important and making a problem. Financial services, what does financial services mean? Financial services means all you are meaning, this is covered money exchangers, banks. So credit cards, like credit card you are doing, credit card payment you are making, the payment is not, whatever the service charge on the payment is that one, like 600, 500, it is 5%. Now clarification for that one, money transfer. Here your remittance is very high from GCC. So it was the question whether the whole remittance will be VAT applicable or no. No, they have already made clarification. It will be only the service charge, like you are sending 15 Riyal or 20 Riyal, on that will be VAT applicable. Now coming to that tax period, they have already Mr. Adnan have defined from 1 month to 1 year. UAE have already selected 3 months, and within end of that quarter, within 28 days, you have to file return with whatever you have to pay or refund claim. This all already agreed in GCC will be electronically paperless, no check, no bank transfer, or will be allowed, only designated will be deducted from your bank account which you have already declared that when sufficient money should be there for the tax. And this return will be filed, it will be in Arabic, and return have to be filed quarterly. Now refund of tax, each country have to announce their own refund policies, and it is well known till now that in UAE they are saying that the first 18 months there will be no refund. Because the main purpose of VAT is to collect revenue which is a shortage, so refund policies is according that one. Apportionment is basically technical one. You have already, Mr. Adnan, that is zero rated, and then you have exempt supplies all. That's why the time is less, I don't want. Refund of tax for international organized diplomats in UAE, they have not allowed for diplomat, there will be no refund. For international organization, there will be refunds. And you know that only UAE have declared is going to declare that law have regulated. Rest of the GCC country till now, there is no announcement from them. Now zero rated supplies, again in UAE already in GCC, according to the GCC VAT treaty, international transport of passenger and goods and service related to e-transport, which is for all GCC countries, they have agreed that it will be zero rated. Certain supply means of transport related to services, new residential building, it will be zero rated. Newly converted residential building, charity related building, educational services in most cases will be zero rated or exempt. In education, again, the education has to be non-profitable or the profit cannot be withdrawn by the owner or shareholder. In that case, it will be zero rated or exempt. Otherwise, it will be standard rate, like training institutes are opened and so many institutes. Unless it is an organization for non-profit, it will not be exempt or zero rated. Exported goods and services for all GCC country, all export outside GCC will be zero rated. Investment in precious metal already is there, means on gold, but this precious metal and gold has to be 99% pure. Healthcare services in most of the cases which I already defined, zero rated exempt. Exempt supplies in UAE have already declared this four local transport is exempt, bar land, residential building, that first 3 years zero rated, after that is exempt supplies, and specific financial services will be exempt. Now some important concept. In this important concept already definition have Mr. Adnan defined this input, output. There are two things, reverse charge mechanism and tax group. Tax group I have already defined that it could be combination of one or two the combination, the definition for the group taxation is that one, that each person have a place to fix. The person are related party, either one person control other or two or more person forms a partnership and control the others. This will be the criteria for the group. Yes. This is on the exemption that VAT group can be created, but intra GCC will be not. This clarification is already there. Yes. Now, one important thing is that one, that free zones. What happens free zone? If you are doing a transaction sitting in Saudi Arabia and you are doing some transaction from Pakistan to China or China to America, it will not be covered under VAT. The clarification is already there, that only thing, unless the services is imported to Saudi Arabia or the goods has been received, it will be under the VAT, otherwise it will not be covered in the VAT. So it means all the free zones transactions are out of the jurisdiction of VAT. Now the reverse charge mechanism, which already Mr. Adnan defined, it works, I have seen like that. Here in this one illustration, just I want to show you how the reverse charge works. You can see the sales. Here you can see there is salaries services received from abroad 100. This 100 is basically a cost, but this is from abroad, means it is not from a place which is under cover VAT. 5% will be added in return, and 5% will deductible from here. So you will add in output, you will deduct in input. So net effect is 0. This is reverse charge. But reverse charge will fail where? Where there is exempt supply. If the supply is exempt, there will no input. Reverse charge. Reverse charge is basically, sir, in purchase year 100 cost in 100 services, salary service received from the 100. So 100 you take service retrieved abroad from abroad, it become 5 on 100, 5% 100. Then you will deduct down there. VAT deductible reverse charge is 5. So you will add up there output, you will deduct input over here. This is reverse charge. Sir, in the cost over here. The cost. Anybody else? Okay. Anyhow, in exam supply, there will be no. And then, that's it, because I have run out of time. Let's have a question answer something.
Thank you very much, Asif Zaman Sahab. It was a very short but very interesting presentation. And for questions from both Adnan and Asif Zaman, they would be sharing their contact details. So if you want to ask questions from them, you can directly approach them for any questions or clarifications. And these presentations will be shared on the website very soon with all the participants. Without further ado, I would like to call Mr. Sarmad Ahmed Khan, who is the chairman of ICAP Overseas Committee and council member ICAP, to give his brief address regarding the initiatives taken by Overseas Committee of ICAP.
Bismillahir Rahmanir Rahim. Assalamu alaikum. I am very happy today to address you on this glorious occasion of 5th ICAP SOCPA Symposium. This symposium, the brief is that it was started by Mr. Tariq Al-Sadhan, who was the chief guest today, who is the DG Taxation, Zakat and Tax, and also His Excellency Vice Admiral Khan. Then SOCPA's DG, Mr. Ahmed Al-Mughis, and also President ICAP. Thank you very much all for this glorious occasion. Basically, I'm the chairman of Overseas Coordination Committee. What it is that we have a total membership base of around 7,000 members, which are spread all over the world. Out of 7,000, 2,500 members are overseas. And for that, we have created this Overseas Coordination Committee, which takes care of their matters. We have 5 chapters. Saudi Arabian chapter, which is the most vibrant and our best performing chapter. And then we have Bahrain. We have also established that in Qatar, UK, Canada also, and also we are now planning to set up chapters also in USA and Australia. My role is to coordinate with these respective chapter presidents, and take their feedback and input, and then take them to the council for a decision-making process. What we are here, I'm very honored to be here. We have you must have known, we have a MOU with SOCPA. Mashallah, our association with SOCPA is growing day by day, and we are very pleased to be with SOCPA. Inshallah, future that cooperation will grow further. I won't take more time. The presentations were very good. Like we had these very good sessions, IFRS sessions, and then we had the 2 taxation, the VAT presentations also, which I enjoyed them the most. And then we had these transition to IFRS. That was very good to watch. In the end, I would say my thanks and my gratitude to everyone. I won't take further time, and then because we are a bit running late on time from me. It's my 3rd day in Saudi Arabia. It's first time I've come to Saudi Arabia, and by looking at the warmth and how the people are welcoming us, it's just unbelievable. And I'm very happy for all that, and we are a friendship of Pakistan, Saudi Arabia, Zindabad.
Thank you, Samad, and apologize for giving you such a short time. With this, our formal symposium is going to end with the vote of thanks from Mr. Mohammad Iqbal, our President of ICAP KSA Committee of Members. I would like to invite Mr. Mohammad Iqbal to come on the stage.
Assalamu alaikum once again. Bismillah ar-Rahman ar-Rahim. I think I would take 2-3 minutes extra because it would not be fair and justice if we don't say thanks to those people who deserve for this. As you can see, a lot of effort has gone to arrange this event. And mashallah, I will start with those people who are not visible to us, like the people sitting back home in Pakistan in ICAP, the way they have contributed in developing the designing the brochure and the website and all these things, and designing the agenda. So they are right from inception. They are with us, they are helping us, especially, the Khalil and the President, they are also involved, and alhamdulillah. So those are the efforts which are not visible, but I would like to recognize those services as well, and we are thankful to them. The second thing is that while these people, the ICAP office bearers, the Sarmad, the Nadeem and all these things, and ICAP as a whole, we appreciate the way they recognize us. They always tell us the best chapter out of the ICAP. But as president of this chapter, I would be happy that every year we should progress. Still, I feel that we are not perfect. We still have a room to improve. So this is the message for the newcomers, because tomorrow we will not be here. Somebody else would be handling the management committee. So the message is that, you should start from where we end. So we should see the progress every year. If you feel that this program is better than last year, then I would feel that yes, we have done some value addition. Did we add something compared to last year? Thank you. I think that's all I want, that every year we should add something. Now, I'm also thankful to the sponsors who have contributed generously to facilitate this function. As you see that without the support of funds, this arrangement is not possible. So we are thankful to them, and especially those who have been every year with us. They are like our partners. The 4 audit firms, the Equa, the Yasser is, I think, second year. Al-Marai is, I think, this second year. Saudi Orex is also, I think, second or third year, right? So we take them as our own community, our own partners, and we hope that they will continue like this in future as well. And the third one is that, as you can see, if you feel that there's a value in this event, believe me, our CPD also, we try equally good to participate, to give value as much as we can. So please try to attend our CPDs as well, and that's just a token money of 150 riyal, and out of that we also give dinner also. So that would encourage us that, okay, yes, we are adding some value, we are parting knowledge. So this is two-way traffic. If you would not have come here, probably this event would have not been successful. Same as CPD. We would appreciate if you can also grace our CPDs so that we can, with the passage of time, we can improve all these services to you people. The last but not the least, the organizing committee, I mean, besides the management committee, there's an organizing committee. They are our unofficial military we have, is that, I mean, the Farooq, Irfan Ali and Umar and Khilji, Mr. Khilji, Ashar, all these people, I mean, we really appreciate the way these people are always available whenever we call them, or sometimes even without calling us, they are offering their services and they try to help us out. And lastly, the management committee that who shared their views, participated in a big way from right from this Khobar. I mean, the Shahid has especially, I mean, showed a great effort that not only he himself is here, he has brought a lot of people from there, and this is not the first time. He also did the same thing in our family event and in our previous annual events. So we are thankful to Shahid as well for his valuable contribution, and we hope that tomorrow's event at Khobar also will be equally successful. I'm sorry that because of my son I would not be able to go there, but I wish him all the best and all the success tomorrow as well. With this, I mean, thank you very much and for your time and all the interest which you people have shown. Thank you very much.
Thank you, Iqbal Sahab. Now the final shield is to be delivered to Mr. Asif Zaman for his presentation on VAT, and I would like to call upon Nadeem Yusuf Adil, President of ICAP, to give the shield to Mr. Asif Zaman. Jaldi, jaldi. Atif. Mr. Asif Zaman especially come from Dubai for this event. Many thanks to him. Thank you, Adil Sahab. Of course, many other people whose name were not called, but that is nothing that was unintentional. So hats off to everybody who participated. Hats off to all of you who participated. MashaAllah, we had a record participation of 300 today. And offline, we had more than 100 people watching the live streaming. So, alhamdulillah, this was the first time, more than 400 people participating, and we wait for your feedback to be received through the website icapksachapter.org or the mobile apps on Android and iPhone. You can download the mobile apps and give your feedback through those platforms. Finally, now officially the symposium is going to end, but the last and not the least, the surprise part is remaining, which is the two lucky draws for the 2 travel tour packages for Istanbul and Kuala Lumpur. Who wants it? Raise your hand. Everyone, mashallah. There are only 2, by the way. And organizing committee is barred from it. They are not part of this draw. So I would like to request Mr. Farooq to handle this and generate the 2 random numbers in front of the camera so that everybody can watch it. What is the first number? Atif? Umar. Number 43. The name is number 20. 2020. Mr. Inayatullah Nazir Qureshi. Is he here? Those who will be here will be eligible. So, the first. Okay, choice is yours. You can receive from. Enjoy Inayat. And this is with your wife. Don't go with somebody else. Go with your wife only. And the second number? $140. And the name is Sayyid Mohsin Ali. Is he here? This is for Malaysia. Please contact us whenever you plan to go. There are some validity dates. So please contact us whenever you plan to plan these trips. With this, again, I would like to extend my heartiest thanks to all of you, especially the ladies who came in big numbers. Many thanks for your participation. And we request the organizing committee, the speakers, the guests to come forward for a group photo. May I request the organizing committee and the speakers to come forward for a group photo.